If you're looking for a one-and-done investment that handles literally everything for you, XGRO is likely at the top of your list. It's the flagship growth ETF from BlackRock's iShares lineup, designed specifically for Canadians who want an 80-20 split between stocks and bonds without the headaches of manual rebalancing. But as the competition between Vanguard and iShares heats up, many investors start asking, is XGRO MER actually low enough to beat out VGRO? And more importantly, does the specific way iShares slices up the world with a heavier lean into the US market, making a better engine for the long-term wealth? In this deep dive into XGRO, we're going to break down the XGRO dividend history and compare it to head-to-head against its biggest rivals like XEQT and VGRO. By the end of this, you'll know exactly why this single ticker is currently one of the most popular choices on TSX and among Canadian investors. So let's get right into it. To start, let's answer the fundamental question. What is XGRO? To put it simply, it's an asset allocation ETF. Instead of buying 5 different funds for Canadian stocks, US stocks, and international bonds, for example, you buy this one ticker. BlackRock's managers then take your money and spread it across several other iShares ETFs to maintain a perfect growth balance of approximately 80% equities and 20% fixed income. Because it is listed on TSX, you buy and sell it in Canadian dollars, just like regular stock. Over the past year, the XGRO price has shown incredible resilience, reflecting the strengths of its underlying global holdings. It is built for the set it and forget it kind of investor, someone who wants to capture the growth of the global economy, really, while having a small 20% bond cushion to soften the blow during the market volatility. Now let's look at XGRO competitors. When you look at XGRO, you see 2 main competitors. First one is the Vanguard equivalent, and another one is the all-equity version. First, let's look at XGRO versus VGRO. While they're both 80-20% funds, XGRO holds a slight edge for a fee-sensitive investor, with an MER of slightly lower 0.2% compared to VGRO 0.24%. Furthermore, XGRO tends to have a slightly higher allocation to US stocks, roughly 36%, which has historically helped it edge out VGRO during years of American tech dominance. But there is a debate of XGRO versus XEQT still, and this is about your risk tolerance. XEQT is 100% stocks, no bonds, no safety net. If you have a 30-year timeline and a stomach of steel, XEQT might be for you. But for a lot of investors, the growth profile of XGRO is kind of the sweet spot. The 20% bond allocation provides just enough psychological stability needed to stay the course when the market inevitably dips, without sacrificing too much of your long-term upside. So now let's look at the XGRO Holdings. It's a fund of fund, meaning it holds other specialized iShares ETFs. The largest chunk is ITOT or ITOT, which gives you exposure to the entire US stock market. Following that is XIC, covering the Canadian market, and XEF for developed international markets like Europe and Japan. And all of this ensures that you aren't just betting on one country, you're betting on the entire world, which hopefully gets better over time. On the fixed income side, XGRO holds funds like XBB, which is a broad universe of Canadian bonds. This 20% ballast is what separates XGRO from a more aggressive fund, like XEQT. It's also worth noting that last year, BlackRock reduced the management fee on XGRO even further, down to 0.17%, proving their commitment to being the most cost-effective all-in-one solution for Canadian DIY investors. But let's look at the dividends now. A huge part of the XGRO dividend history is the consistency of its distributions. Because XGRO holds dividend-paying stocks and interest-bearing bonds, it pays out a distribution to its shareholders every single quarter. Last year, the XGRO dividend yield has typically hovered between 1.7 to 2.3%, depending on the total market performance and year-end capital gain distributions. The XGRO dividend date usually falls at the end of March, June, September, and December. And for most long-term investors, the best strategy is to set up a DRIP or dividend reinvestment plan that allows your broker, whether it's Questrade or Wealthsimple, to take those quarterly cash payments and immediately buy more shares of XGRO at the current XGRO stock price at that moment, triggering the powerful effect of compounding interest without you having to log in and place a trade manually. So anyways, guys, let's summarize. Who should buy XGRO? The verdict for XGRO is clear. It's one of the most efficient, low-cost, and diversified tools available to Canadians today. It takes the complex world of global asset allocations and shrinks it down into one simple, easy-to-manage package. Whether you're using a TFSA, RRSP, or a non-registered account, XGRO is designed to be a core forever holding. So I would say, look, choose XGRO if you want a growth-focused portfolio, but you still want a 20% bond cushion for safety. It is ideal if you prefer BlackRock's lower fee structure and their slightly higher weighting towards the US stock market compared to Vanguard. Then I would say you should choose XEQT if you're purely focused on maximum growth and are comfortable with 100% equity volatility. So again, it's about your risk tolerance. And lastly, choose XBAL if you're closer to retirement and you want a more conservative 60-40 split instead of 80-20 between stocks and bonds to preserve your capital. I hope that kind of clarifies some things. But anyways, let's wrap up. Just a quick reminder before we finish, this video is for educational purposes only and it's not financial advice. I'm just a guy sharing my research and my personal opinion, so please make sure to talk to a professional before making any big moves. And if you enjoyed the video and found any of this helpful, please hit that like button and subscribe to the channel. I would really appreciate it. It really helps the algorithm realize that these videos are somewhat watchable and they actually bring a tiny bit of value to the personal finance community here in Canada. Anyways, guys, thank you so much again for your support. And I'll see you in the next one. Take care. Bye.